Welcome to the December National Trends Update. I'm Nick Elder with Ironton Capital, and I'm joined by yours truly, Joe Massey. How you doing? So nothing in here is confidential, of course, at least for this presentation. Typically, if you go forward with any kind of investment, that information is confidential. There's a possibility you'll see some forward-looking statements such as project, expect, plan, and seek. And of course, this is not an offering of investment opportunity. This is our monthly real estate trends update. But I must check off the compliance box and make sure that this is in here. So a little bit of background on Ironton Capital. Some of you on this call are investors with us. Some of you may in the future be investors with us and be our limited partners. So just a quick overview here. Brent Geyer, he's our CEO, very deep background in real estate acquisition, development, worked for a number of large developers throughout the mountain region of Colorado, nationwide developers as well, held various VP of finance positions, VP of acquisitions, also a former accountant from KPMG, where he specialized in mortgage banking. So point to all that is he is our CEO. He is a rock star, and he's got a very impressive track record and background here. And he's joined by Lon Welsh. Lon Welsh, he's our founder, also founded Your Castle Real Estate Company. Lon's got many years in strategy consulting, worked for some of the big accounting firms, over 20 years of commercial real estate acquisition. He started Your Castle, which became the largest independent brokerage, and then sold that off to a private equity company. Then he started a First Alliance Title and sold that off to Compass. So track record of starting companies and then ultimately exiting those companies to large institution firms. And then Richard Landry, he's our chief investment officer. So responsible for leading all the investment procurement, research, the modeling of the fund, doing the due diligence on everything that we ultimately invest in. Used to work on Wall Street at Goldman Sachs, was a CIO at a multi-billion family office, and formerly was the chief financial officer at Break of Day Capital. So that is Ironton Capital's investment team. And then I'm on the investor relations side. I don't make the investment decisions, but I get to talk with so many of you, which I certainly most enjoy about my position. So that being said, Joe, take it from here.
Absolutely. Thanks so much for the introduction, Nick. As Nick mentioned, over on the right-hand side is the chat box. I'm going to politely ask everybody, put in one thing that you want me to talk about tonight. This is our entire list: consumer confidence, national trends, how do real estate downturns work? Are prices going to drop? Is there going to be a foreclosure boom? Will mortgage rates go up or down? That's my favorite topic. I talk about that every single day. How do increasing interest rates impact the market? What's next for rentals, apartment updates, and new home updates? I would love it if you guys would put in the chat, which things would you like me to focus on? We have about 100 slides tonight. We will skip some. Some we're going to spend a little bit more time. But if you guys would tell us what's most important, what do you want to learn about? We're going to go ahead and get started, but please make sure you interact with us, because otherwise it's just, me and Nick making stuff up. But one of the big slides that there's a reason it's number one is this is something we've been looking at a lot, is consumer confidence. And the University of Michigan talks about, or does a survey on consumer confidence every month. And the results recently have really been shocking. And if you look on the far right-hand side of each of these graphs, you're going to see consumer confidence is at a low. On the left side chart, consumer confidence is at a low for the last 10 years. On the right-hand chart, it is at a low for the last 60 years. That means that for the last 60 years, consumers have less confidence about the future of the economy right now than at any point in the last 60 years. So let me pause there for a minute, Nick. Do you think, if you're thinking about buying a house or buying a car or buying a dishwasher and you're unsure about where the economy is going, might you say to yourself, you know what, I'm just going to wait and see what happens?
Absolutely.
Yeah. And that's a big thing we're seeing right now. I talk to clients every day and they said, Joe, we want to be pre-approved, but we're just not sure what's going to happen. So we want to wait and see what happens. And so if you're making any type of big purchase, or if you have clients making big purchases, this is really a leading indicator that they might sit on the sidelines for a while. So just don't be surprised by that as you're talking with your clients.
And I want to mention something here. Some of the best deals have historically been bought in times like this. I mean, at the end of the day, if you're waiting for things to come around, you're already too late. You've already missed on the upside. You go back to like 2008, 2009, 2010. I mean, the number of investors I know who have bought during 2010 where the cost basis was so low. I mean, there are multimillionaires just from making an early buying decision.
That's right.
You know what I mean? And so, we're not going to see a major correction like we saw in 2010. There's just not a global housing crisis that's going to happen. Affordability is an issue, but there's not a crisis where, there's a much larger thing at play here, like what happened during the housing crisis. But, at the end of the day, it's probably some of the best times that we've seen to actually buy something when everybody's so hesitant, people are uncertain. I mean, Joe, you're on the closing table from a lending standpoint. I mean, buyers have so much leverage.
Oh,
They get concessions.
yeah.
I mean, sellers want to get rid of their properties. They have a lifestyle change, or from the commercial side, they're obligated to, or their lender's telling them they have to sell it. And so there's all kinds of reasons people are wanting to sell right now, and they're selling in a down market. So like, if you're a buyer waiting around, I think, stop waiting. Your basis is as good as it's probably going to get right now. And if you wait another couple years, when interest rates start to trickle down, hopefully, you're probably already too late. You're going to be competing with everybody else who's now coming off the sideline. So I'll get off my soapbox, but
dude, you're so right.
Yeah.
I mean, I could give you example after example after example of my buyers getting incredibly good deals. I'll pause just for a second. Tell you, one of my buyers' property was listed for $1.3 million. He got it for $1,070,000 and got a $40,000 seller concession. So do the math on that. He net paid for it $1,030,000, and it was listed for $1,300,000. Now that property was listed for 6 months, and so they had a frustrated seller who just wanted to get rid of it. I bet I could give you 15 of those examples from the last 90 days. So if you've got buyers, or you are a buyer right now, everybody in 2020 was complaining they couldn't find anything, couldn't find a deal. There are deals out there right now, guys. And this consumer sentiment is going to lead to further deals as we enter into the end of the year and as we get into the spring. So get your buyers off the fence is the big thing that we want you to look at.
Joe, real quick on the chat box, we've got some, people commenting here. They want to talk about the rental market in Colorado. How bad will it get and for how long? From one of our attendees. Foreclosure boom from another, mortgage rates and how rates impact the market, et cetera. And then is there any hope nationally or in Colorado for from a legislative perspective to get real estate insurance pricing under control, particularly for condo and townhome? So we asked the question, people answered. So let's make sure we address those as we move through the presentation. Yeah,
I will definitely spend time on each of these because we do have slides for each one of these. Now I want to pause here and look at this. The left-hand chart is how many people think it's a good time to sell. And you can see that is really slid since the COVID unicorn years. But on the right-hand side, how many people think it's a good time to buy? Virtually no one, except for me and Nick. We're here on the far right-hand side of the right chart up at like 160. We think it's a great time to buy because we're seeing clients get deals left and right. And so when there's a lot of people that think it's not a good time to buy, you might take a contrarian approach and think, should I look at it while everybody else is on the sidelines? Maybe I should get in the game. Inflation, we've touched on this in prior presentations. Inflation is really remaining sticky, right around 3%. That impacts consumer sentiment. Unemployment, very, very low right now. We did get some negative unemployment news just yesterday, I think it was, that unemployment has now up to 4.4%. So we are beginning to see that go up as compared to where it's been over the last 6 to 12 months. And this is what's driving that is job growth is slowing down. So you can see the blue and orange line. This is job growth over the last 5 years. We're not seeing a lot of jobs being added to the economy right now. A lot of people say, well, why is that? We've got consumers that have really low sentiment and they're saying, hey, I'm going to wait and see. Guess what? Business owners are doing the same thing. They're saying, I probably need 1 or 2 more people, but I'm going to just work a little bit harder, put a little more stress on the folks that already work for me, and we're going to wait and see what happens before we hire anybody else. Compounding that, layoffs. On the right-hand chart, you see that dark blue line. That is layoffs for this year. And we've had more than 1 million people laid off in the United States in the past 10 months. That's a pretty staggering number when you see that and then compare that to really low job growth. So if you get laid off, you might have a tough time finding a new job. And that, again, is part of what leads to that low consumer sentiment of, hey, I'm just going to sit on my hands and take a wait and see approach. And I think this is a big one too. People are worried about an upcoming recession. Nearly 2 out of 3 Americans think a recession is coming in the next 12 months. And 74% of people admit that world news and current events affect their financial decisions. However, I don't think we are going to have a recession. Most major economists do not expect a recession in the next 12 months, and GDP is expected to grow 1.7% in 2026. So, Nick, let me ask you: are you in the camp that 66% of people think there's going to be a recession, or are you in the camp with the major economists that think there is not going to be a recession?
I think there is not going to be a recession.
Yeah, I completely agree. We do a lot of economic studies. Lon helps us with a lot of charts. He finds all sorts of stuff. I actually do have a degree in economics, and I don't see it. I don't see that there's going to be a massive slowdown. Now, what I do think we're going to experience is what's called a rolling recession, meaning that certain segments of the economy are going to be in a recession at different times.
Yeah.
And I think we've been in a housing recession for at least the last 3 years. And anybody who's on the call who's a real estate agent, you have probably felt that. We're not having as many buyers. Sellers' properties are sitting on the market longer, and transaction count is very, very down as compared to where it was at in 20 and 21. So I think we're certainly in a housing recession. We're going to have some price declines. We're going to talk about that. But somebody asked, how bad will it get and for how long? Well, I think that depends on your point of view. If you're a real estate agent, I think we're kind of at the bottom for transaction count, and we're going to begin to see transactions improving next year. If you're thinking about what's going to happen to home prices, I think we've seen pretty stagnant prices this year. I think next year we're going to be up 1%, maybe down 1%. I don't see anything that's going to be a big breakout that's going to cause a big increase in prices. But I think we have probably another 6 to 12 months of just kind of low, stagnant activity. Do you agree with that, Nick?
I do. You look at, the median first-time home buyer age is now 40 years old nationwide. Yeah. And it used to be much earlier than that, maybe early 30s, but affordability continues to remain a major challenge. The markets that were affordable, you're seeing median home prices now in the mid 400s, 500,000s, even for those markets that are affordable. In Denver, you're up to 650, 700,000. That's 6 times what the median income is in Denver. And so I think that we were not going to see crazy growth, for example, like in the residential side. And I'm glad, Joe, recession is macro level. We can break it down into like a housing recession, right? And so I do believe that we'll probably stay flat, pretty stagnant. I think we're going to see low turnover of properties. I think that with the first-time home buyer age now approaching 40, they're renting for longer, either in apartments or they're, if they're younger, they're moving back in with their parents to save money. I don't expect that going away anytime soon. I think some major policy shifts need to occur for those numbers to look more optimistic.
Yeah, I completely agree with you. This is one that I think is really important here is how many people are behind on their bills. So look on the far left-hand side. Everyone in red are homeowners. Everyone in gray are renters. And the sort of peach color is all adults. So we're going to talk a little bit about foreclosures, but I want to bring your attention to right in the middle there. How many homeowners are behind on their mortgage? That's that really small red line. It's less than 1%. So are we going to have a foreclosure boom? Not in the foreseeable future, because less than 1% of people are behind on their mortgage. If you have less than 1% behind, some of those people are going to get caught up. Some of them are going to go to foreclosure, but you need a very large number of people behind on their mortgage before you're going to see a large number of foreclosures. So this is leading to stability in prices. We're going to see, again, some stagnation. Some areas may go down, some areas may go up, but we're not going to see a foreclosure boom that's going to lead to a massive 10, 20, 30% decline in prices. Now, we did have a question here. Stagnant market doesn't quite mesh with the buyer deals you were mentioning earlier. I think we may see some further medium price drops as the next few months data appears. I think you're right. We certainly may see price drops. And what I mean by a stagnant market is there's not a lot of transactions occurring. I think our transaction count is down more than 25% from the peak years of 20 and 21. But because of that, buyers can get better deals. Because there's fewer buyers and there's more sellers, buyers can get a lot better deal, particularly from a desperate seller, which I see quite a few of. Do you see quite a few desperate sellers out there, Nick?
Yes. In fact, a lot of people that are now building townhomes right now, they're actually having to pivot to leasing those because they can't get enough buyers interested in the product. So I've talked to 2 or 3 developers in Denver in the last month who are facing that. They've had to get very creative to the point where they're offering new buyers, for example, any investors that want to buy the property, they'll pay for the HOA cost for an entire year. They'll manage the lease up process for them. And so they're getting very creative, or if they can't sell it, they're having to lease it out to a tenant. So, maybe there's a medium price drop. At the end of the day, nobody knows what's going to happen. Anything can happen, but nobody can time the market either. So in a stagnant market, I think that does create a lot of opportunity for buyers. It gives them leverage when they go to negotiate on a sale price for any product, especially that's been on the market for 60, 90, 120 days.
Yeah. And part of that's leading to a later home buyer age or fewer home buyers is it takes longer and takes more money to save up for a down payment, right? And this is what you were touching on earlier. The median age of a first-time home buyer is now 40 years old. So go back to 2000, pre-global financial crisis, that was like 32 years old. Now in 2020, that was like 33, 34. And just in 5 years, that first-time homebuyer age has gone up to 40 years old for the median first-time homebuyer age. So we're seeing a lot of people renting for longer or living with family for longer. And then this is one of my favorite charts. If you have not seen this, if you're working with any buyers or first-time buyers and they're just uncertain, I think this is a chart that every first-time homebuyer should see within the first 5 minutes of your buyer consult. On the left-hand side, you start with the average, the median net worth of a renter at the bottom, which in 2010, that median renter had a median net worth of $5,400. The median homeowner had a net worth of $187,000. Follow that chart all the way to the right. 12 years later in 2022, the median renter now had net worth of $10,400, but the median homeowner net worth was upward or almost $400,000. So this is a chart that I would show to every first-time home buyer. If they're on the fence or they're uncertain, the sooner you buy, the sooner you're going to ride that wealth accumulation ride. You can continue to rent, and we're going to talk a little bit about rent prices versus monthly payments, but that appreciation really offsets and covers up a lot of that pain by owning that property and having it appreciate while you're the one that owns it. Nick, is this something you share with folks on a regular basis?
A lot of the folks that we talk to, they're investors that have been in the game for a couple decades. But I've got friends and whatnot that don't own homes, and or friends that are maybe they're going onto their second home, and the ones that have already owned their first home and owned their property, that they understand this chart. Mm-hmm. The ones that haven't bought a property, they understand it, but again, it's can they save up for the massive down payment, and can they afford the monthly payment, right? And so those are the sticky situations for those people that want to buy a home for the first time. So I mean, it's a very clear as day chart. Real estate's a long game. It's a slow wealth building game, but over a couple decades, this chart becomes more and more pronounced relative to the person who rents for that same time period.
Yeah, I think you're exactly right. So let's talk a little bit more about national trends. What you're seeing here is the number of home sales per 1,000 homes in the first 9 months of the year. So take the first 9 months of every year, how many homes transacted in the first per 1,000, and you see the peak in 2020 and 21. at 44 homes for every 1,000. And now on the far right, we're down to 27 homes for every 1,000. So if we talk about it feels slow, it feels stagnant, this is why, right? Home sales are down more than 25%. I'm not talking about prices, but the number of transactions, the number of properties turning over are down more than 25%. And we still have a lot of real estate agents and a lot of mortgage lenders that have not left the industry yet. There's been a lot leaving, but there's still more to go. I think when we have license renewal numbers come out in January or February, we're going to see another big chunk of people that have gotten out of the market. The lock-in effect, this is easing. So I really like this chart. If you look at the left chart and the top section that is in orange, these are the people that have a mortgage interest rate below 3%. And you see that really became pronounced in 21 and 22. And what I really love about this chart is I talk to people every day who say, Joe, I have a 3% mortgage. I'm never moving. Okay, I totally agree with that until you move. And what you see is that orange section at the top is becoming smaller because life goes on. You have a 3% mortgage, but you get transferred for your job. You have to sell. You get divorced. You get married. You have a baby. There's a death in the family. So as we have fewer and fewer of those 3% mortgages, fewer and fewer 4% mortgages, and fewer below 5% mortgages, what you see is that lock-in effect is not nearly as pronounced as it once was. We are seeing people transact and move even though they have really beneficial financing. And that is helping more properties come on the market, which has its own challenges that we're going to talk about. Now, this is, again, talking about the number of home sales. So right in the middle, the orange and blue line, this was prior to COVID. This was pretty normal that in any given year, we would transact about 5 million to 6 million homes per year. Well, what happens during the COVID years? We had upwards of 7 million home sales in 20 and 21. Well, what does that happen now in 23, 24, and 25? That's down at the very bottom, where we're transacting between 4 and 4.2 million home sales per year. So we took a lot of home buyers and a lot of home sellers and fast forwarded those sellers and buyers with really low interest rates during the COVID years. So it's going to take some time, probably at least another year, before we start reverting to that mean of 4.5 to 5 million home sales per year. Would you agree with that, Nick?
Yeah, I would.
Yeah. All right. We're seeing inventory level off. We did see some spikes earlier in the year. Now we're seeing inventory really be pretty stagnant and kind of right around the pre-COVID normal years. So a lot of folks say there's so many homes on the market, there has to be a foreclosure boom. This is actually pretty normal. Now it feels like there's a ton of homes because it's a ton compared to 2 or 3 years ago, but it's actually really normal as compared to the years prior to the COVID booms. Marketing time. This is a big one that we see. If you look at that yellow line at the very bottom and that green line at the bottom, during the COVID years, the average days on market fell as low as 29 days in 2021. And now we're back to roughly 60 days that it takes on average to list and sell a home. But Nick, let me ask you this. Do you ever hear about anybody listing their home and selling it in the first weekend?
Not often. It's happened.
Yep, it happens.
It's got to be a property in a A++ location that is unique in some capacity. For example, Wash Park, a place like that. Many other neighborhoods around, where people really want to live. So, I mean, the whole adage location, you can't replace location. You can't pick up a house and move it. So, I think your chances of days on market being a lot less are greater if you've got a prime property in a very strong location in an in-demand area. Otherwise, I think that you will be pushing the 60 to 70 day on market if you're not in that category.
Yeah, I think you're exactly right. And I also think pricing matters. If you have a property that has a couple of flaws, maybe it's not in the best location, you need to be pricing that property appropriately in order to get it sold rapidly. Or you might suddenly be sitting there and have listed that home for 60 days or 90 or 120 days. And guess what happens at that 60, 90, and 120 day mark? There's buyers out there that will make offers that are going to want massive inspection items, massive seller concessions, massive price cuts. So pricing really matters in today's market, particularly when you're coming on the market with a new listing, because you don't want to be on the opposite side of this chart where you've had that property listed for 90, 120, 180 days. You're just going to have a frustrated seller. So I think really walking your sellers through these charts is really critical in the current market. Now let's keep going. Let's talk a little bit about prices. So you see the brown line at the top. There's some seasonality to this, that the highest prices are usually in the summer months, but we are seeing prices really level out. And the median listing price was up 0.4% year over year. So not a huge increase in listing prices. So that's important as we talk about, I think we've got a slide in here somewhere about home price growth. Here it is. Look at everything on the left-hand side, the western side of the United States. You're seeing some actual price declines in the Northeast and the Midwest. You're seeing in blue, there's still some strong increases in those markets. So on average, I think we're right around 1% as a nation that homes appreciated this year, but that is very localized. If you look at Colorado, homes have gone down about 2.9% this year. If you've got condos, you probably saw a further decrease than that. I know a couple of condos I have declined in price between 7 and 9%. Fortunately, I'm holding those properties for the long term, so I'm not concerned with it. But if you are trying to sell a condo, you're probably not going to get the same price you would have gotten 2 or 3 or 4 years ago. What do you think about that, Nick? Is that true?
Absolutely, yeah. And I'm looking at a lot of things from the lens of commercial. So, when you see residential's down about 2.9%, if you look at like multifamily, for example. I mean, we're seeing prices in multifamily dating back to 2015 when you're looking at things from a price per door standpoint. So we're retracing back a decade in prices on multifamily, rents down. For example, in multifamily, 10 to 20%, depending on where you're at in the area. Multifamily pricing nationwide's down 20 to 25%. So everything you're looking at here is residential, guys, but it's exasperated in the commercial side of things.
Yeah, absolutely.
Yeah.
So let's keep going and talk a little bit about how downturns work. So this slide seems so obvious, but I love this comment. Every downturn ends in recovery, right? And that's always been true. Go back to the 80s, 2008, you're going to have a downturn. It's going to be painful for a certain number of years. Then you're going to have a recovery. Same thing happened during the COVID years. We're in a slowdown right now that high interest rates and high prices have slowed demand. At some point in the future, we're going to see that demand pick back up. Now we're going to see what do they call it? A hockey stick recovery? Probably not. We're probably going to see kind of a long, slow recovery in the medium-term future. Now, Nick, we had a question here. Are you seeing small multifamily 4-plex to 12-plex come back to 2015 numbers? What do you think about that?
So 4-plex and 12-plexes, they're valued differently. A 4-plex is going to be valued with a 4-plex comp somewhere in the area. If you can find a nearby comp, those are traditionally pretty difficult to find. Whereas a 12-plex is going to purely be driven on the income that it produces, divided by a cap rate. Now, obviously, it depends on the area, just like residential, it depends on the area. If you're buying a 12-plex Class C, a lot of buyers don't want to touch that. You're dealing with tough legislative issues, and delinquency rates are higher from tenants in Class C property. So I think that Class C, low Class B, maybe in places like Aurora or Lakewood or some other place where that would be deemed where some areas are deemed a lower class. They are tracing back to 2015. Your Class A townhome, 12-plex or 6-plex or 8-plex, not necessarily the case, if it's a new build or what have you. So again, it depends on the area, just like the residential side of things. Definitely much larger multifamily. Yes, we're seeing tracing back down to 2015, just given where the debt environment is and the downward pressure on overall income produced by that asset. So hopefully that answers your question.
Yeah, and we have a slide for that. And an important point too, I think it's important to understand it's not necessarily where the property is listed, because many sellers are still optimistic in the current environment. Now, where does the property sell? Very close to a 2015 number, but it takes 60, 90, 120, 180 days for the seller to see the reality and finally get desperate enough to take a lowball offer. once they just have to get rid of that property. Would you agree with that, Nick? It doesn't necessarily start at a 2015 list price, but often ends at a 2015 sale price.
Yeah, I'm so glad you said that. I mean, look, at the end of the day, guys, we can list with the most ambitious target, but that's not always the reality. Sometimes a broker tells their buyer or their seller exactly what they want to hear, and not what the realistic answer is. And then before you know it, they're taking price improvements that are really just price declines because they were off from the beginning. So exactly. You might list it, at X, but maybe it trades at, 3/4 X, right? So we're seeing that happen quite a bit. I mean, sellers, they're looking at what their property was worth 2021, 2022, and they're trying to get that. But the reality is it's the property is not worth that anymore. So oftentimes in the commercial realm, you start to see properties rotate through the cycle every 6 months. Maybe they're with a different brokerage because the first one overpromised on a list price. It happens a lot. See it quite a bit on the commercial side. I see it a lot on the residential side too. So,
Nick, I want to draw your attention on the slide we still have on the screen here. Looking at the orange line, and we look at the 2008 Great Financial Crisis, and you see that prices go down until about third quarter of 2009. In third quarter of 2009, looking at this chart, was that a good time to buy, seeing that recovery coming after that?
1,000%.
What do you think people were saying at that time? Do you think they were saying it was a good time to buy?
No, they were terrified, right? I mean, people were losing jobs. This was a global financial crisis driven by the housing market, and very bad decisions made from a lending standpoint by Wall Street, right? So, looking at this chart, but just like anything, we go through cycles. And if your time horizon's 20 to 30 years, it's hard to say that you'll lose at the end of the day. Yeah.
So the reason I asked that is if you look on the far right of this chart, 2022 to current looks kind of similar, right? Now we haven't had quite as massive of a downturn, but everybody right now is saying it's a terrible time to buy, but at some point we're going to have a recovery. This is where Nick and I take an opposite approach. Now might be a really good time to buy because we're going to have a recovery coming at some point in the future. And people tell me all the time, boy, I really wish I could go back to 2009 and buy properties. This is your next best opportunity right now.
Yeah.
All right. Let's talk about, are prices going to drop? Because I think we had some questions about, and then actually we'll talk about the foreclosure boom. So are prices going to drop? I want to touch on this right here because there was another question here about property insurance. So one of my favorite topics, interest rates. Everybody's upset because interest rates started going up in 22. But what people fail to talk about is what has happened to monthly escrow costs, taxes, and insurance. If you go back and look 10, 11 years ago, the average monthly escrow was just over $400. Now the average monthly escrow is approaching $700. All right. That is nearly doubled over a 10-year time period. So the question earlier, is there any hope to get real estate insurance or property taxes under control? I don't have any data to support it. I would say no. I don't see any great paths to get homeowners insurance under control. I know there's looking at doing a statewide insurance of last resort. I don't know. I don't remember the acronym for it. But I think you just need to build into your model that insurance is going to go up 7, 5, maybe 10% a year. What do you think, Nick?
Yeah. What's challenging is when we're buying, we can't control those items, right? So your best bet is when you're underwriting a deal, just factor in that it's going to increase. Because if you're factoring in that it's going to decrease, that may be very far from reality. So, when I'm underwriting a deal or I'm looking at stuff, I'm going to assume that insurance is going to go up. I'm going to assume that taxes are likely going to go up. And I think you're doing yourself a disservice and putting yourself in a tricky situation if you're assuming the opposite.
Yeah, I think you're exactly right. Now, another one, 22 of the 50 largest metros have falling home prices. So there was a question earlier about, what's happening in Denver, and highlighted in red, you can see that our home prices are down about 3%. And I believe this is only detached. This is not including condos. This is just detached homes. Condos, I think, would have probably another 7 to 9%, depending on the particular condo. So a lot of folks in 20 and 21, so many people told me, oh, I'm just going to wait for prices to come down and then I'm going to buy. Well, they're on their way down. We're not going to see a 25% reduction. I think next year we're going to be kind of in the same boat, plus 1%, minus 1%, pretty stagnant.
We have a comment here from Andrea. Our HOA condo master policy went up 240% between 2020 and 2025. No way to project or account for that. Yeah, I mean, that is unbelievably tricky. You can't possibly guess that. That is a very high percent, and I'm sure I bet some other folks on here who own condos might 540%. So yeah, exactly. I mean, there's no way to project that. You're exactly right. It's very challenging. That makes underwriting or trying to understand if what you're about to buy is a good deal even more tricky and challenging. So
yeah, absolutely. All right. This is a forecast from National Association of Realtors. They expect home prices to go up about 1.7% in 2026. I really like this slide. Home equity values in the last 5 years are up 80%. The next 5 years will likely have below average appreciation as we revert to the mean. One important point, though, is home equity appreciation still outperforms the stock market. So back to what Nick and I were talking about earlier, still a very good time to buy, in our opinion. Even if home prices appreciate 1, 2, or 3%, we're eventually going to see a recovery, maybe a longer drawn out recovery, but owning that asset when it's recovering is going to be better than trying to buy it and time the market. So I think there's still a lot of upside on owning properties. This is another one that I really like. This is home prices over the last, more than 30 years. Look at the appreciation in Colorado. We're the third highest. Homes have appreciated 569% since 1991. The national average, 297%. So it's not terribly surprising that homes have gotten really expensive as compared to incomes, and we're going to see a little bit of slower home price appreciation. We've really outpaced the rest of the country for the last 30 plus years. Now, here's a big one, though. Recessions. If we have a recession, does that lead to lower home prices? And I want you to look at the chart on the left. These are the last 6 major recessions. The only one where we had a meaningful decline in home prices was in 2008. Home prices went down nationally by 19%, but that recession was caused by home prices going down 19%. 5 of the last 6 recessions were recessions based on global or national economic factors, and home prices actually went up during those recessions. So if we have a recession, which we spoke about earlier, I don't think we're going to, but if we do, that does not automatically mean that home prices are going to crater. One of the benefits, though, of a recession is when you begin to exit that recession, you will see reduced interest rates. So you look at the last 3 recessions, you see an interest rate reduction by about 1% as you exit that recession. I don't think we're going to see a recession next year, so I don't think we're going to see a big 1% reduction in interest rates. What do you think, Nick?
Yeah, I would agree. I don't think that we're going to see a meaningful change in that regard. We'll see what happens when, Jerome Powell leaves the office, right? And maybe we move into, a Fed chair that believes that we should be in more of a quantitative easing situation moving forward. So, we'll see kind of how the economy looks, and we'll see what happens with interest rates. But, it's so difficult to forecast.
I completely agree. Now, is there going to be a foreclosure boom? One of my favorite questions. I want to bring your attention to Colorado right in the middle there. There are 0.1% of homes that are in the foreclosure process. Nationwide, 0.13. Guys, that is nearly zero. So are we going to have a foreclosure boom that's going to cause a massive decline in prices? No, we're just simply not going to. And why not? Homeowners are sitting on record amounts of equity. The chart on the left shows the amount of equity as compared to debt nationwide. And if you look there right after the financial crisis, we were actually, as a nation, upside down, where we had more debt than equity. Now that equity line has climbed nearly off the charts, that we have more equity than we have ever had in the United States. And the pie chart on the right, 38% of homes are owned free and clear. That's nearly 40% of the market that cannot even go into foreclosure because there's no loan. And 28% of those homes that do have loans have less than or greater than 50% equity, right? So that's nearly 70% of homes, 67% of homes that are not even remotely at risk for foreclosure. You're not going to see a foreclosure boom, guys. Now, even in good times, there's still foreclosures. You might see somebody that bought a home 2 years ago and now has lost their job. Certainly, that might become a foreclosure. You might see somebody that had a down payment assistance program that bought a home a year or 2 years ago and now is maybe upside down. But as a nationwide view and even a Colorado-based view, very few homes are in foreclosure. We are not going to see a massive foreclosure boom that's going to bring a ton of homes on the market. This just reiterates that point. The chart on the right-hand side, we have $35 trillion of equity as compared to $13 trillion of debt. That is not a leading indicator for foreclosures, guys. So if you're hoping for that in order to pick up some deals, I don't think that's going to happen. And negative equity, you can see here, right there in the middle, 4.2% of homes in Colorado have negative equity. That would be exactly what we just touched on. Folks that bought a home in the last 2-3 years have not experienced any appreciation, maybe put very little money down, maybe have lost a job or have had some insurance or tax increases that are leading to trouble. That's a very low percentage of homes that have negative equity as compared to nationwide after the financial crisis, where as a nation, we were actually upside down on debt versus equity. So are we going to have a foreclosure boom? I absolutely do not think so. Nick, please disagree with me.
I can't disagree with you. And the chart that you showed beforehand, I think is probably, sorry, one before. Yeah. I think this chart is, if somebody asks, is there going to be a foreclosure boom? This is the first slide that I would pull up.
Yeah.
It explains it without even having to say a word, quite honestly. There are a lot of people who were underwritten poorly. You go back to 2008 to, why a lot of the folks that got in homes were on adjustable rate mortgages. They shouldn't have got a home in the first place. Their income, job wasn't being qualified for them to get a home. And like you mentioned, Joe, the housing crisis caused it. So all of a sudden, everybody, most of the people that you had to walk away from home, people lost jobs, unemployment rates spiked. Now they couldn't afford the home that they shouldn't have been in the first place because their mortgage rate doubled or tripled or whatever the case may have been. That led to a complete switch in equity. I mean, most people were upside down in equity. So you have to sell, and you have to sell at a major discount. So like you said, Joe, nowadays, there's other options. If you can't make your mortgage payment, you could probably refinance, or you could sell because you have so much equity on it. Even if you have to take about a 20-30% discount from list, you probably still have enough equity to get you through it. So I think this chart does the best at explaining why I don't believe we'll see a foreclosure boom.
Yeah, I completely agree. All right. Our mortgage rate's going to go up or down. I love this chart. This is what interest rates have done for this past 12 months. We started the year greater than 7% during that first or second week of January. Now interest rates are just below 6.2%, which has dropped the median mortgage payment by more than $350 since the summer. So we've seen a lot of our clients coming back to refinance. We've seen a lot of our clients, lowering their interest rates or taking advantage of lower rates in order to buy right now. Long-term projections, this is a couple of months ago, but Fannie Mae, Mortgage Bankers Association, and Wells Fargo all predicted interest rates would slightly go down through the second half of 2025, which they've been correct on that, and hope for additional slight decreases through 2026. I would really agree with this. Folks that are hoping for rates of 4%, not going to happen. Folks that are afraid of rates of 8%, also probably not likely to happen. I think we really need to adjust our expectations and help our clients adjust our expectations that a 6.25% rate, 6.1, 5.9, That's really a great interest rate to buy a home. And that is actually still well below the 50-year average of 7.76%. So many of our clients and so many of our friends and family are really focused on the 2010 numbers of 4% rates or the 2020 numbers of 2% rates. Guys, those were the strange times. Right now, interest rates of 6.2%, that's very, very normal. And you can buy a home at a 6.2% interest rate, hold it for 10 years, sell it, and probably make a lot of money. I remember people, some of my early clients that told me about buying their first homes in the 80s and the 90s with 10, 12, 15% interest rates. They held it for a number of years, made a ton of money. I think that exact same thing is going to happen now. We just need to focus our attention that a rate of 6% or 6.25%, that is not the end of the world. There's still a lot of opportunities, even at rates that are higher than the 2020 COVID years. All right. How do increasing interest rates impact the market? So this is a chart that we use to track showing per listing, showing per active listing, excuse me. And increased interest rates do put a damper on the market. So you see the pink line at the very bottom, all the way over in November, we're seeing just under 6 showings per listing per home right now. So very important to understand, every showing is really, really important. If you look at the green lines up at the top, 2020 and 21, we had 12, 13, 15 showings per active listing. Increased interest rates have really tampered that demand. And now every listing is like gold. So you really want to make sure your home is in tip-top shape when you have a listing, because you're just not going to get as many. And so these increased interest rates come back to what we were talking about earlier. Slower showings lead to lower contracts, lead to lower transactions. So it does put a damper on the number of transactions that we're going to see. This is one of my favorite new charts that we've added in here. You probably have some folks saying, well, I don't want to buy because interest rates are high, prices are high, taxes and insurance are high. It just makes more sense for me to rent. So let's look at this blue line that starts over on the left-hand side at 0, and the solid blue line goes all the way over to the far right-hand side. So this is somebody who bought a home 20 years ago in 2006. Their appreciation and how much money they've made on that home has made them $181,000 on average. Let's say that same person had a brother who said, I'm not going to buy, I'm going to rent. That is the dashed blue line that goes all the way to the far right. The brother that didn't buy has spent $268,000 in rent and has nothing to show for it. So the person that bought the home, yes, they paid a mortgage payment. Yes, they paid taxes and insurance, but they gained appreciation, which made them $181,000 minus $268,000. What's that? $420,000 or $440,000 more wealthy than their brother that didn't buy a home. Now, a lot of people say, okay, Joe, that's great, but they had that big appreciation surge during, 2012, 2020, et cetera. Well, I want to draw your attention to the really light blue line on the far left. So this person, the solid line, bought a home in 2022. They've already built about $60,000 worth of equity through their appreciation and principal reduction. The person that began renting in 2022 has lost roughly $70,000 of rent that they've paid and have not regained that with any appreciation. So this is a really important slide. I'd say all the way back with the slide that we showed on net worth growth for a renter versus a homeowner. I would really look at and understand this slide and share this with a buyer when they say, well, I'm just going to rent because it's cheaper than buying. That might be true, probably is true on the amount of money that's going out of your pocket. But what about the appreciation and the equity growth that you're not getting? This is a number that'll compound over time, and a lot of folks don't understand this. So I hope that's helpful for you. Now, what's next for rentals? I know we had somebody that said they were interested in this. Nick, can you touch on this chart? This is one that you really understand based on the number of housing units or the size of units that are in the rental pool.
Yeah, so guys, this breaks down, if you look at 100 grid number being 100%, about 33 or about a third of that is a single family rental, and then you go up from there The next largest is 50 plus units the largest of 50 plus units at 38%. The next largest is your single family rental, and then it goes down from there. So this just shows you the distribution of rental housing units, by size. One thing I think, if you're somebody looking at multifamily, you're looking to progress up, build your own portfolio. I think there's a lot of opportunities in that 2 to 4 unit, 5 to 24 unit, 25 to 49 unit. Competition is a bit more scarce. There's not as many people looking at that, and I think you can find a lot of inefficiencies in those unit counts. So, this is a simple factual chart, but I think I like to mention that I own about 53 units in Northwest Arkansas, 2 buildings that are about 25 and 28 units, and it's a sweet spot. If you're looking for limited competition, more inefficiencies, ways to increase value. And buying from, ultimately owners who've owned it for many decades and haven't kept up with the renovations. So I like this chart, but it definitely goes to show that majority of what's out there is your single family home or a 50 plus unit building.
Mm-hmm. Long-term rentals. This is a big sticking point. The legislation in Colorado has become very landlord punitive, I might say, very tenant friendly. So all of the new laws from 2023, 24, and 25 have all favored the tenant. I'm a big believer of having a property manager to manage your long-term rentals. And I think if we had Eric Ross here, he would agree with that. If you're managing your own rentals, there is a lot that is in favor of the tenant, and you really want to make sure you're following these laws. And then apartment and what's happening with rentals. The United States, and I would say even Colorado, is still structurally short of housing, and rentals are a big part of that. So Nick, you touched on earlier, apartment prices decreasing back to some of the 2015 prices. So this orange line at the top is our peak prices on apartments, and then we really see that start to decline. And now we're really seeing that we're kind of leveling off. But with certain transactions, we are seeing them in certain sizes back to some earlier year numbers. But do you feel like we're poised for a rebound in apartment prices?
It's really hard to say. I think when we look at the headwinds that have occurred in the multifamily side, we dealt with interest rates that have skyrocketed. That's been a headwind for affordability and for pricing. We've had an excess supply come into the market. I mean, you can imagine everybody could get a really strong loan in 2020, 2021, and early 2022. If you wanted to start a new project, you could go get a 3.5% loan, a 6.5% construction loan. And so everybody was wanting to start, right? Ultimately, all that activity led to a drive up in supply that hit the market in 2023, 2024. So we saw interest rates come down, which put a lot of downward pressure on valuation. We saw supply come into the market, which put a lot of downward pressure on rent growth. Ultimately, rent was down, 10 to 15, 20% in some markets. And so, yeah, you can never time the bottom. I can tell you, we're finding some really amazing deals at Ironton where we're able to get just deals at an exceptional basis from people that bought many years ago and they're in financial distress and they have to liquidate, as an example. So you're never going to be able to time the market, whether the bottom is 2 quarters from now, 3 quarters from now. But what I can say is there are going to be some tailwinds that will be in our favor. One of those being we're seeing a bit more relief on interest rates, which is good, but we need to see more. We're also seeing we're moving into a market that's going to be very supply constrained. You look at Denver multifamily, new construction starts are down, or deliveries are down about 60 to 70%.
That's right.
We're absorbing a lot of those units still, but once those get absorbed, there's not going to be much left. And what's great is we can look out. It typically takes 2.5 years to build a new apartment complex. So we can look out 2.5 years and see what supply is coming on the market.
And there's very little.
There's very little. That's one of the things that we know, that we are certain of. We don't know what's going to happen with interest rates, but we know that supply is plummeting, which will be really good for apartment owners. Ultimately, theoretically, that would mean rent growth would normalize, perhaps in line with inflation. That's really good for property valuations. So we've got some tailwinds kind of coming, in our direction. I think interest rates will continue to remain a headwind. But if we start to see some growth on the income side, that'll be good for property valuation. So we'll see. I think that we're near a bottom if we're not at a bottom, but nobody can time the market. At the end of the day, if you're buying during the bottom, you're probably going to fare well over a 10-year time horizon.
I completely agree. And this is exactly what you just touched on. The number of new apartments starting construction is going to continue to fall. That's good for those of us that own apartments. It's harder to raise capital for new builds. Again, good for those of us that already own properties. There's not a ton of distressed properties. The overall number is really not that high. Are we going to see more distressed properties in industrial, multifamily, office? Maybe. Office, maybe a little bit, because everybody works from home now. I probably wouldn't buy an office building right now, but outside of that, multifamily, I think, is still a very strong market. And then this is good for us, the gap between supply and demand, right? We're getting a lot of those units are getting absorbed. There's going to be a lot fewer supply coming in the future, which is going to lead to increased rents. I do think rents are going to be pretty stagnant for probably the next 12 months. And this is a big reason here. We are seeing retention is remaining really, really high. So the number of people renewing is upwards of 56%, meaning they've been in that apartment for a year, 2 years, 3 years. They're going to renew for another 12 months. That's great because vacancy is the enemy. So I think for the apartment side, this is all very positive. And household formation, also very strong. This is, somebody moving out of their parents' home or moving out from living with a roommate. And we're seeing that in renter growth. Our household formation is mostly focused on renters, not so much on home buyers. So those of us that own apartment complexes, own rental units, I'm very bullish on where we're going to be going with apartments and rental prices in the future. And I think we have touched on pretty much everything that everyone asked us to speak about. This rents, again, going to be soft. I don't think we're going to see any major rent declines, but we're not going to see any major spikes in rents either. So the big thing, renew your tenants. That's a big thing I focus on right now. And then forecast effective rent per unit will likely increase as we have fewer supply coming online. Would you agree with that, Nick?
Yeah, I would. Yeah. And on the tenant renewals, I agree with that. Absolutely. You might have to give a little bit to keep that tenant there. In talking with other, operators, they've had to maybe give a concession on a renewal or drop the price by $25 a month. And I can say that is absolutely worth it to keep a tenant in there rather than vacating that tenant, spending $1,500, $2,000 to turn it over, just to then let it sit vacant for maybe another month. That $25 per month less that you're getting is far less that you'll lose than if you were to have to vacate that tenant, turn it over, and lease it back up just to maintain that same rent. So I think if you're in a position where you might be able to negotiate a little bit with your tenant, come down a little bit in rent, it's probably worth doing to ensure that your occupancy and income can remain stable.
Yeah. Nick, we had a question here. Why is there so much office building going up in Cherry Creek North? I haven't seen any new office buildings. I live right in Cherry Creek. I've seen several high-rise residential developments. Have you seen any new office, Nick?
I have not, but I think what we've seen is downtown office has been hit hard. Not, major downtown markets, right? I think where you look at some other maybe sub-markets, office hasn't done as poorly. Maybe those companies are requiring their, folks to come back to the office. So I don't know. I mean, it could be a variety of reasons, but I think office has declined considerably. Just like any asset class, I think there's going to be opportunity, and it's possible that people are seeing some of those opportunities in the office side of things.
Yeah. So that is 7:00, guys. Thank you all for the questions. Thank you all for the comments. I'm going to put my information in here if you guys would like to chat with me about, home financing for a new purchase or refinance. Would love to chat with you. Nick, if you want to put your information in there, please.
Yep.
Okay. Well, guys, thank you so much for joining us. Really appreciate the comments. Really appreciate the questions. If you want to learn more, reach out to Nick, reach out to myself. We would be more than happy to chat with you one-on-one. Really appreciate it, guys. Thank you, Nick.
Yep. Thanks, guys. Take care.